Hi, my name is Sweta Singh, and I'm a fixed income portfolio manager at City Different Investments. Today, I wanted to talk to you about Moody's downgrade of US government debt and what does it mean for your portfolio. Moody's last Friday downgraded US debt from AAA to AA2. The reason being, growing budget deficit. What impact has that had on US government debt? As of May 19th, the 10-year US government debt or Treasury debt stands at 4.49%. So there's been some yield rally between 3 to 5 or 6 basis points, considering the time of the day you're looking at this. Now, rising debt service cost and a growing budget deficit are not surprising. However, we believe that these factors will continue to cause the yield curve to further steepen. Moody's downgrade has not been a surprise, but it does come at a time when the market has been volatile. The federal budget deficit currently stands at 6% of GDP. Moody expects this number to widen up to 9% of GDP in a decade or by 2035. The three horsemen here are rising interest rate payments on these debt, growing entitlement spending, and third, low revenue growth for the government. Okay, so this is the problem that I have encapsulated, and it's not a new problem. This has been growing across more than a couple of administrations and slowly making its way to the forefront of the market. Now, what does this mean in terms of US or non-US buyers of Treasury debt? This is something that has been circling the headlines for a couple of months now, that because of this trade tariff and trade uncertainty, non-US buyers of US debt are dumping US Treasuries. Now, is that truly the case? And this is especially true in relation to China. Okay. So according to Treasury data, as of March 2025, foreign demand of US debt has not been significantly impacted or decreased. However, what has changed is China's ranking as the holder of US debt. That has changed. China is now in the number 3 position after UK at number 2 and Japan at number 1 holder of US government debt. Currently, Japan owns 1.13 trillion of US debt. And foreign buyers as a whole account for 30% of US government debt. So the headline news of mass dumping of US Treasuries, it doesn't really match up with the data that came out from Treasury Department as of March 2025. Now, the second factor of downgrade risk. None of the factors that I encapsulated or summarized earlier were new to the market and have been a problem that has built up over many decades. We still do believe in the resiliency of the US Treasury market and support by various parts of the US government and Federal Reserve to support this market. Remember that the US government does have revenue-raising capabilities. I hope you enjoyed understanding the backdrop of what has happened with regards to US debt. For any further question, please feel free to reach out to us at City Different Investments. Thank you.